pivoting away from gas to the oil side, oil bulls are happy right now. I mean, as of this recording, I haven't checked it today. I think we're in the 90 something dollar range a barrel. And there's people clamoring, reports saying $150 a barrel. There's people saying, don't fight the Fed. Look at the yield curve. The recession's coming. Oil's going to go to $60 a barrel. Just your thoughts on where we are today. Just thoughts about kind of scenarios that could play out in the oil space here over the next kind of short and medium term.
With oil, I think that's saying it was the best of times, the worst of times kind of applies to oil right now because you have prices almost close to triple digits. But if you look historically, what that means from where we are in the economic cycle and kind of what comes next for stocks, it typically isn't that great.
Right.
So oil is outperforming other sectors. That typically only happens at the beginning of economic cycles and at the end. I think we can all agree we're not at the beginning of an economic cycle with some of the headwinds we're looking at with the Federal Reserve policy and other issues. And so this is one of these things where you want to be cautious. And I think if you look at the stocks, they already are. Typically, you don't get the full credit for where prices are. And that disconnect is starting to widen where the stocks haven't really been moving along with the commodity. You would have been better off just owning oil in the last 6 months instead of the stocks. So it just puts more pressure where we are today on inflation. And obviously that's a problem because then if the Federal Reserve keeps rates higher, that puts pressure on the value of stocks. Now, we were talking with Warren Pies, who is a really smart guy on oil. He made a call that oil would go up the last 6 months, got it 100% bang on. He's a good guy to talk to. And he was trying to explain why oil isn't really able to discount the future like a stock. A company, you'll say, well, I think next year will be like this, and that's kind of priced into the stock. Oil just works on what is supply and demand right now. Yes, there's a futures curve, but think about are they really pricing in the chance that demand falls 5%? It's really based off of that where demand is now. It's kind of a today weighing mechanism for oil. So he thought that's why you see these periods where even though there's all these economic headwinds and growth headwinds, oil's still doing great because the consumer is still holding up. They're spending. Demand is still better than expected. And so prices should be high because demand's still high. Even if, say, there's a cliff coming, if we knew in hindsight that the consumer is going to really pull back, stop driving, demand's going to fall 3% like it did in '08. Well, that's obviously not being priced in if we're at $100 oil. So I would just caution people this is great. There's definitely some supply issues. OPEC is cutting as demand has held up much better than people expected. But typically, you see this type of move, and then the other sectors, lagging near the end of a cycle, and there's risks to demand in that situation.